So you have decided to invest in the stock market and with the possibility of earning significantly higher returns for your money over the long term than with classic savings products. If you have never bought a security, a stock, as a beginner, you probably have a number of questions. We answer the most important ones in this video. The first question that usually comes to mind is, how much money should I invest? You won't hear a concrete figure from me now, of course, but I mention a few principles that you can use to find the answer for yourself. Firstly, don't invest everything you have in your first security. You should build up a safety net beforehand. If you haven't done this yet, please watch our video, 5 tips to build up wealth. If you do have money ready to invest, then our second tip is only invest an amount of money that you will not need in the short term for a specific occasion. There are always fluctuations on the stock market and prices can rise as well as fall. If you have planned a certain amount of money for buying a car next year, you should not invest it in the stock market now. Third point, only invest so much that the loss of this amount would not affect your standard of living. If you buy a stock, aka you invest in one company, you have to bear in mind that in the worst case scenario, it could go bankrupt and your share would be rendered worthless. This is called a total loss. When you start investing, this should not immediately hurt so much that you say, I never invest again. Fourth tip, only invest part of the money you have available for investing in the first security. Then, in the best case, you will have money left over to buy more shares, and that is already the first step towards diversification, a more broadly diversified investment consisting of several shares. When should I get in the stock market? The principle here should be, it is better to invest as early as possible than to wait a long time for the supposedly right time. There's a well-known saying, time in the market beats timing the market. What does it mean? As an investor, you generally fare better if you invested for a long time than if you stand on the sideline for a long time and wait for the supposedly ideal moment. Like for example, for a crash, after which shares are particularly cheap. Share prices move up and down. The course is not reliably predictable, not even for professionals. And that means that by waiting, you always run the risk of missing out on good days on the stock market and thus also miss a part of the returns. There are studies on this. For example, the US investment bank JP Morgan has calculated what happens when an investor invests 10,000 US dollars in the US stock index S&P 500 over 20 years. If they were invested for the whole time, they achieved an average annual return of 6% with the money. If they only missed the 10 best days during that period, they ended up with an annual return of only 2.4%. This means that missing the 10 days cost them more than half of their return. Of course, this example is exaggerated, because if you wait, you're likely to miss not only the best days on the stock market, but also some of the worst. But the example shows particularly tangibly what can happen in the worst case if you do not invest but wait. Moreover, there are now also share savings plans. That is, you don't buy at one point in time, but you choose an amount and invest in fractions of the chosen share month after month. And with such a stock savings plan, considerations about the supposedly right time to enter the market become even less important anyway. Which shares do I buy? You won't hear any company names from me now, of course, but I would like to give you a principle that is, only buy what you understand. Look at what the company whose shares you want to buy produces or what services it offers and in which markets. In other words, how broadly is it positioned? Is it dependent on one market? Does it offer a whole range of products or just one specific product? Get an idea of this yourself. Study the annual report, follow what is reported about the company in the media, and create your own set of criteria. This can be key figures, they can be qualitative criteria. The decisive thing is to inform your own opinion and not to blindly jump on hypes just because everyone is talking about them or because a supposed top analyst recommends a certain share in an advertisement on the internet. And the question of which shares I should buy is the wrong one, at least in the long term. It's nice to start with one. For many, it is also first entry as investors. However, they should diversify relatively quickly. By that we mean not only to inform themselves broadly, but also invest broadly. You should start with one share. With the next money you have available, you buy into a second, and then a third. And also, think about buying ETFs, exchange-traded index funds, because there you can diversify broadly with only one purchase and already a low sum and invest in a whole basket of shares right away. Where do I buy shares? Sure, on the stock exchange. But now the stock exchange is not a place where you go directly yourself as a private investor. You get access to the stock exchange through your bank or through a broker. When choosing such a broker, you should pay attention to a few things. First, take a look at the selections. Are there a sufficient number of stocks, ETFs, funds that you want to buy? Do they cover a range of securities you are interested in? Secondly, look at the fees. If an order costs a relatively large amount of money, then it is particularly noticeable with the initial perhaps small order sums. This money is then gone, and the share you're buying must first earn it back. The Scalable broker, for example, offers a trading flat rate. The individual order is commission-free. Third point, make sure it's easy to use. Are the order screens easy to understand for you, or are they complicated? On which platform can you trade? The Scalable broker, for example, allows you to trade via a web interface from your home PC, as well as via your smartphone while on the move. So what do I have to do to get started? It's not complicated, I can reassure you. First, you open a securities account with your chosen broker. This usually only takes a few minutes. The second step is to deposit money there, because you need an available balance to start trading. This is usually done by a bank transfer or direct debit. Third point, familiarize yourself with the order types. That is the ways in which you can buy and sell shares. Fourth point, choose the share you want to buy and buy it or set up a savings plan on it, and a little later you will have your first share in your account. One final tip, keep calm even if the price drops momentarily. As mentioned, investing is a long-term project. This means that you don't have to get nervous if prices fall in the meantime. With that, I wish you good luck on the stock market and with the purchase of your first share.